Hello, my fellow investors, and welcome back to another earnings report analysis. And today, guys, we have a lot of earnings to get to. A bunch of companies just reported, and I would actually like to take a look at some of these, starting, of course, with none other than the company AMD. AMD, guys, I mean, there really isn't anything to say about this company. Pretty much everybody knows it. It does have like a cult-like following, in my personal opinion, and I have gotten some hate in regards to what I've said about at least their share price recently, which is kind of uncalled for because, to be fair, I absolutely adore their products. I mean, the laptop that I'm recording all of these videos in, guys, uses an AMD Ryzen 5000 series processor. Right, it uses an AMD processor, and I gotta tell you, I used to have like an Intel one before, and ever since I switched, oh my god, I have just not gone back. It's absolutely amazing. So when it comes to the products, this is a really good company overall. However, when it comes to their fundamentals, are you overpaying for what the company's giving back to you? Well, that's something that we're gonna find out. So with that said, let's get started with these analysis. So we're going to start off, guys, with Seeking Alpha's earnings report summary. Now, they do not have it updated, but we do get to see the estimates. EPS normalized came in at 67 cents, EPS GAAP estimate 21 cents, and revenue estimate of $5.52 billion. But we actually do have reports of what they already got. We got AMD got non-GAAP EPS of 69 cents, beats by 2 cents, revenue of $5.6 billion, which beats by $80 million. So as you can see, they did pretty good. Now let's actually come into, guys, their actual earnings report. And of course, like every single one of these earnings report analysis, guys, all of these will be linked in the description below if you guys would like to read it for yourselves. And of course, before we move on any further, let me just remind everybody that this is not financial advice, and please do your own due diligence. This is why I give all my calculators available for free, as well as I put all of these earnings reports in the link in the description below, so that way you guys can do your own due diligence for them. So let's start this off. Record full year revenue of $23.6 billion, up 44% year over year. AMD today announced revenue of the fourth quarter 2022 of $5.6 billion, gross margin of 43%, operating loss of $149 million, net income of $21 million, and diluted earnings per share of 1 penny, and non-GAAP biased gross margin of 51%. Operating income was $1.3 billion, net income was $1.1 billion, and diluted earnings per share was 69 cents. For the full year 2022, the company reported revenue of $23.6 billion, gross margin of 45%, operating income of $1.3 billion, net income of $1.3 billion, and diluted earnings per share of 84 cents. On a non-GAAP basis, gross margin 52%, operating income was $6.3 billion, net income was $5.5 billion, and diluted earnings per share was $3.50. Let's actually come over here and compare some of these numbers to Q4 of 2021. We got here revenue in millions. 2021, guys, it was $4.8 billion, and in 2022 it was $5.6 billion. That is an increase of 16%. Gross profit 2.42, or let's just say 2.43 billion to 2.403 billion, so it was essentially flat. Gross margin, it went down 740 basis points from 50% to 43%. Operating expenses 1.22 billion to 2.55 billion, that is up 109%. Operating income loss went from 1.21 billion to negative 149 million, that is down 112%. Operating margin went from 25% to negative 3%, down 28 percentage points. Net income went from 974 million to $21 million, down 98%, and the earnings per share went from 80 cents down to 1 penny. But that was the GAAP quarterly financial results. Let's actually take a look now at the non-GAAP. We got over here revenue 4.83 billion to 5.6 billion, so exactly the same as it was before, up 16%. Gross profit 2.43 billion to 2.86 billion, up 18%. When it comes to the gross margin, 50% to 51%, up 70 basis points. Operating expenses 1.1 billion to 1.6 billion, that's up 45%. Operating income 1.33 billion to 1.26 billion, that is down 5%. Operating margin 27% to 23%, that is down 4 percentage points. Net income from 1.122 billion to 1.113, so it was essentially flat, and the earnings per share was 92 cents to 69 cents. So this is actually fairly interesting because right here we see that, well, when it comes to the revenue and just gross profits and net income, it was either going up or essentially remaining flat. Yet, when it comes to the earnings per share, we can see that they went down 25%. Earnings per share, guys, it is the earnings divided by the shares outstanding. So the fact that this went down, even though they had a record profit, tells me that they're issuing shares. And if you guys remember anything of this company, at least when it comes to their fundamentals, their shares outstanding is god awful, like really, really bad. So it's not surprising that we're now seeing a decrease when it comes to the earnings per share, not because it's anything bad with the company like making money, it's because they're just diluting investors non-stop left and right. And now taking a look at what the CEO had to say, we got 2022 was a strong year for AMD as we delivered best-in-class growth and record revenue despite the weak PC environment in the second half of the year, said AMD Chair and CEO Dr. Lisa Su. We accelerated our data center momentum and closed our strategic acquisitions of Xilinx, significantly diversifying our business and strengthening our financial model. Although the demand environment is mixed, we are confident in our ability to gain market share in 2023 and deliver long-term growth based on our differentiated products portfolio. So while that's all good and dandy, I actually want to take a look, guys, at their outlook. This is huge. And there's actually something here that I think it's going to be a bigger deal than what people are making it out to be right now. But we'll get to that when we get to that. We got here, AMD's outlook statements are based on current expectations. The following statements are forward-looking and actual results could differ materially depending on market conditions and other factors set forth under cautionary statement below. For the first quarter of 2023, AMD expects revenue to be approximately $5.3 billion plus or minus $300 million. Note here, guys, take a look at this. A decrease of approximately 10% year over year. That is massive. That is absolutely massive. And you want to know something? I think this is what's causing the share price now to go down after market once these earnings actually came out. I'm going to show you guys exactly what I mean by that. Nonetheless, it goes on to say, year over year, the client and gaming segments are expected to decline, partially offset by embedded and data center segment growth, and AMD expects non-GAAP gross margin to be approximately 50% in the first quarter of 2023. So that's pretty much all I wanted to cover when it comes to the earnings report. Again, linked in the description below if you guys would like to read the rest of it. But now let's head over into the calculator and let's actually take a look at this with a much wider range. We got the ticker symbol for AMD, market cap of $121.2 billion, a P of 45, dear Lord, a 45 PE with a current share price of $75.15. This is down, guys, on the year 34.22%, which is massive. And even after 34.22% decrease, it still has a PE of 45. 52-week ranges is $54.57 to almost $133. Absolutely crazy. Now, take a look at this. We come over here to their share price, how it traded in the intraday. However, post-market, you can see is up 1.37%. You're like, oh wow, it's actually doing really good. Except for the fact that a couple hours ago, I kid you not, a couple hours ago, this thing was up almost 4%. It was insane. 4%, and then it has to slowly start to tick down. It's pulling a Microsoft when they had earnings. Remember that? When Microsoft had earnings and Microsoft stock went up like 4% in the span of like 5 minutes, and then throughout the rest of the night, it just kept crashing, and then it ended up being negative the following day. By the looks of it, this is heading in that same direction, but it still hasn't gone in the red yet. Still though, it went from around 4% to now 1.38% in the positive. Now, AMD does not pay out a dividend, which is actually a good thing in my personal opinion. Obviously, there are other ways for companies to give back to their shareholder aside from just issuing a dividend. However, the other ways, it's, well, not really that good, at least when it comes to AMD, right? AMD is doing a lot of bad stuff, especially with those shares outstanding, but we're going to take a look at that in just 1 second. Nonetheless, though, their last year's free cash flow is definitely higher than the 5-year average, so they're at least growing that free cash flow. So let's run over these fundamentals really quick. We got the net income 5 years ago of $337 million to 1 year ago of $2.27 billion, increase of 574%. We do see a massive outlier from 4 to 3 years ago. They kept it going from 3 to 2 years ago, but then as of last year, 2022, they brought it down from $3.2 billion to $2.27 $2.27 billion. So for that reason, the fact that they have gone down as of what, from 2 to 1 year ago, just a little bit, and we do see a massive jump from 4 to 3 years ago, I'm giving this guys a 40%. And now coming over into guys, the free cash flow. This one, it is a doozy because, well, the margins just keep getting wider and wider and wider. 5 years ago of negative $129 million. That's right, negative $129 million. To 1 year ago of, take a look at this, 3.41 billion. Negative 129 to 3.41 billion dollars, guys. That is an increase of 2,742%. And this means that they have an average of $1.5 billion. Really, really good. And by the way, for all of you guys who are watching this, you're like, wait a minute, I just saw the free cash flow change from here to here, like the average 5-year free cash flow. Yeah, I'm so terribly sorry about that. I mistakenly put the wrong capital expenditures in my calculator. I put in the cash from operations twice, so my bad. Their average is 1.5 billion, so sorry about that. Obviously you guys are going to see a different number, but yeah, just let you know that was my mistake. It's $1.5 billion when it comes to the 5-year average. And we can see, guys, that this is like an insane increase, right? I mean, negative 129 to 3.41 billion. They had a massive jump from 3 years ago, 777 million, to 2 years ago of 3.2 billion. Absolutely crazy. For these reasons, guys, I'm giving this a 35%. Looking now at the revenue, we got 5 years ago of 6.47 billion to 1 year ago of $22.83 billion. That is another massive increase of 252.56%. Now, this one actually isn't looking as bad as the other two metrics. At least the spikes in revenue aren't that big. I guess you could say that was a pretty big spike, right? From 9.76 billion to 16.4, and don't get me wrong, that is a pretty big spike nonetheless. But compared to like 777 to $3 billion, yeah, this looks a little bit more, I guess you could say, linear looking than the rest. So for that reason, I'm giving this a 75%. Looking at the total assets minus total liabilities, this just gets ridiculous at this point, right? You can see here from the past 5 years, sure, they have been positive. However, take a look at this massive, massive jump from 7.5 billion to $54.5 billion. Guys, like at some point, you're like, okay, that is a massive outlier. That cannot be sustained. Now, the fact of the matter is that when it comes to this, they mainly just got a whole lot of assets. That was mainly it. Like their total liabilities increased as well, but they went from $12.42 billion in assets to $67.8 billion. So that's the main reason why this is like this. It's a good thing, don't get me wrong. I just do not like the outliers. So, you know, I'm giving this a really low grade, but nonetheless, average total assets, it is 32.61 billion. Average liabilities is 7.56 billion. Doing this difference, we get $25.1 billion. I'm giving this guys a 20%. Now looking into the cash flow minus the liabilities, this one started off really good, and then as of 1 year ago, it just went into the gutter. You can see that, well, from 5 to 2 years ago, it was pretty consistently going up. Like it was heading in a really, really good direction, right? And then as of 1 year ago, boom, they just collapsed. And it mainly has to do with the fact that they just had a lot more liabilities. Even though their cash flow has grown, they took on $13 billion in liabilities, as I just showed. So, you know, the fact of the matter is that, yeah, they were going up pretty good from 5 to 2 years ago, but 1 year ago it's right there, right? It's like right there. It's right at the premises of what we are today. So I don't necessarily like that. Now, average cash flow minus average total liabilities, we get negative $4.1 billion. I'm giving this a 55%. And now when it comes to the, oh boy, the shares outstanding. This one, guys, silent killer when it comes to investing. And I get a lot of, I guess, hate when it comes to this one because people are like, well, no, you don't understand why they're doing it. Apparently, I've heard a rumor. I don't know if this is true or not, but apparently I heard a rumor that the CEO was issuing shares because she bought like a private jet or something. I have no idea where that rumor came from. I tried to find it. I could not find a single thing. So, you know, the fact of the matter is that whether that rumor is true or not, that's not really the point, and it doesn't really matter. What matters is that they are increasing shares by a whopping amount. 5 years ago of $1 billion to today of $1.6 billion. Increase of 60% on the 5 year, guys. 60%. Absolutely insane. And when it comes to the previous year to the current year, just looking at 2 years ago, $1.21 billion to 1.6. Guys, that is an increase of half. They've literally done, well, they've issued half of the shares in 1 year within the past 5 years. Think about that. More than half of the shares that were issued in the past 5 years were issued in 1 year. Think about that. So for that reason, I'm going to have to give this a 15%. Really, really bad, guys. They're diluting you to no end. And when it comes to the cash and equivalents, they currently hold $3.4 billion with an average of $1.9 billion. Looking at the overall grades, we gave the net income of 40%, free cash flow 35%, revenue 75%, assets minus liabilities 20%, cash flow minus liabilities 55%, and shares outstanding of 15%, for an overall grade of 42%. Biggest issues I have here, guys, is this free cash flow as well as the net income, mainly because massive outliers. And honestly, it's not just that, it's the assets minus liabilities, massive outlier there, and the shares outstanding is just awful. It really, really is. They're just issuing shares nonstop. So I'm giving this a 42%. And now let's come over here into the most controversial part of this video, and that is my target share prices. Because, well, last time I got a comment that I'm not going to repeat it now. I'm going to try and save it for when the time comes. And I want to put this person like right on blast because it was hilarious to see. But nonetheless, guys, I'm going to make low, medium, and high assumptions. Revenue growth of 4, 5, and 6%. Now, if we come over here to the growth tab on Seeking Alpha, we can see that the forward is estimated at 36.74%. I'm sorry, like, I like AMD. I'm not saying that they're bad. Like, when it comes to like their chips, I'm not saying that they can't take market share, but 36.74%? Really? No, I'm sorry, but just simply no. I'm gonna go 4, 5, and 6%, as I just said. And the projected share buyback, guys, of, let's face it, they've been issuing shares, massive issuing shares, and I'm gonna give them the benefit of the doubt. I'm saying that in the next 5 years that they'll do half of what they've been doing in the past 5 years. Negative 35, negative 30, and negative 25. With these answers, guys, we get $12.40 for the lowest assumption to $14.55. Now, if we adjust for debt, this does come up. I gotta give them that, though. They have very, very little debt. This now goes up to $26.31 to $30.75. With a margin of safety of 5, 10, 50%, this puts me between $22.36 to $29.22. Now, most of you guys are like, oh my God, $75 to $30. That will never get there. That will never get there. Guys, let me just remind you all that this thing fell from 136 to a low of 54. 54! If you would have bought this at 52-week lows, I would have been like, yeah, you know what? I guess you could make the case for $54. Like, if you were to say, I don't know, let's say at around 8, 10, and let's say 12%, well, you know what? You are getting a little bit closer here, right? You are getting a little bit closer. So to those that say, oh my God, it'll never fall down to like $30 or $37. Guys, it was $54 like not even a year ago. So you were close. Like, you were really, really close. This thing got to, I guess, my target share price like just a year ago. So the fact that you're saying that, or to those people that say that it'll never fall down to $37 or anywhere remote that, it already did. Okay, like, it already did. So I don't know where you guys are coming from. If you're thinking this, I'm sorry. I'm sorry that you bought at all-time highs and now it's gone down to $75, and you have a random guy on the internet being like, oh, it's probably going to fall down to $40 or so, even though it has already fallen to around that price just 52 weeks ago. So I don't know what else to tell you. These are just my projected share prices, guys. It's based on a discounted free cash flow approach. So basically, what I'm trying to show here is that when it comes to future projected revenues, future projected cash flows, this company should be worth around $37. Every investment is the present value of all future cash flow. That's all I'm trying to say here. You know, do with that information as you will. As I said at the beginning of this video, all of these calculators, guys, are available for free. I have this one, the book value one, the reevaluation one, and a dividend tracking sheet. So all of this is for free because I want to help everybody to make good investment decisions. That's really it. And every investment is the present value of all future cash flow. So please do your own due diligence. So with that said, now I'm not going to say that anymore for the rest of the companies. Just wanted to point that out here right now. Let's head over down to the second company that I would like to take a look at the earnings report, and that is... And now let's head over into the second company that I would like to see their earnings, and that is the company Exxon Mobil. Now, guys, if you know me, right, I love my oil companies. I said when Chevron reported earnings, I said I love Chevron. It's my greatest position to date, and they're paying me a huge dividend. I love their fundamentals. I love the fact that I managed to buy them at an average share price of like $100, and now they're up to 100, and well, the peak was like 188. So overall, I really do like my oil companies. I'm one of those people that believes I don't really care if EVs are taking the hold of when it comes to energy. I don't think oil is going away anywhere for like the next several centuries, in my personal opinion. So when it comes to Exxon Mobil, let's see what we got here when it comes to their earnings. Looking at Seeking Alpha's earnings summary, we got EPS normalized actual came in at $3.40, beat by 12 cents. EPS gap actual came in at $3.09, missed by 17 cents. Revenue $95.43 billion, which was a beat by almost $5 billion. And also something to note before we move on to their earnings, they just declared that they will do a 35 billion share repurchase plan. We're going to take a look at how much this actually is when we go into the shares outstanding and into the assumptions part of the calculator, but just keep that in mind. So now let's jump into their earnings report. ExxonMobil announces full year 2022 results, delivered industry-leading 2022 earnings, cash flows from operations, total shareholder return, and return on capital employed. Generated earnings of $55.7 billion and $76.8 billion of cash flows from operation activities in 2022 by leveraging an advantaging portfolio and delivering strong operational performance. Increased year-over-year I don't know how to say that word, and Permian production by over 30%. Achieved best ever annual refining throughput in North America and the highest global since 2012. Operated Permian assets achieved zero routine flaring as of year-end 2022. Started one of the largest advancing recycle facilities in North America, capable of processing more than 80 million pounds of plastic waste per year. All of that sounds really good. Now let's come into their results summary. We got Q4 of 2022, 12.75 billion compared to Q4 of 2021, 8.87 billion. That is a change of $3.88 billion. In earnings, we got $14 billion in 2022 to $8.8 billion, which is a change of $5.24 billion from earnings excluding identified items, i.e. non-GAAP. When it comes to the earnings per common share, as of 2022, it is $3.09, and as of 2021, it was $2.08. When it comes into earnings excluding identified items per common share, Q4 of 2022 hit $3.40, and in 2021, it was $2.05. And when it comes to capital and exploration expenditures, in 2022 Q4, $7.5 billion, and in 2021 Q4, $5.81 billion. So as you can see, there was a massive gain pretty much all across the board when it came to this. Now let's actually come over here and take a look at what the CEO had to say. We got over here, the hard work and commitment of our people enabled us to deliver industry-leading operating and financial results and shareholder returns in 2022, said Darren Woods, Chairman and CEO. While our results clearly benefited from the favorable market, boy was it favorable, the counter-cyclical investments have made before and during the pandemic provided the energy and products people needed as economies began recovering and supplies began tight. We leaned in when others leaned out. Our plan for 2023 calls for further progress in our strategic objectives, which include leading industries in safety, operating, and financial performance. We will continue to invest in our advantage projects to deliver profitable growth, help meet society growing needs, and reduce emissions in our operations, while providing innovative solutions that help others reduce theirs. So now let's jump into the calculator, guys, and take a much wider look when it comes to Exxon Mobil. We got the ticker symbol for XOM, market cap of $477.7 billion, a PE of 9.45 with a current share price of $116.01. And of course, it is not a surprise that seeing that this company is in the energy sector, I mean, it is one of the biggest players in the energy sector. This thing is up a whopping 52.73% on the 1 year, and in the year to date, they're up almost 9%. 52-week range, it is $74.03 to $126.54. They do pay out a dividend of $3.64, which ends up being a yield of 3.21%, a payout ratio of 28%, 5-year CAGR of 3.02, and 20 consecutive years of dividend payment. To my surprise, they're not a dividend aristocrat, guys. At 25 years is when they get that status. Ex-dividend date passed as of November 14th. Payout date was on the 9th of December, and they pay their dividends quarterly. Based off of the current shares outstanding, they pay out almost $15 billion in dividends every single year. And in regards to the 5-year average free cash flow, after this is paid, they're still left with almost $8 billion. And as of the last year's free cash flow, this is a whopping $44.6 billion. Again, this is mainly due to the fact that, I mean, guys, now the biggest thing that we got with pretty much all of these profit metrics is that 3 years ago they went negative. But 3 years ago, guys, was COVID, so I am not going to necessarily fault them for that. What I'm mainly going to fault them for is the fact that from 5 to 4 years ago, they went down by around $6 billion when it comes to the net income, but they recovered it fairly nicely afterwards. It's of 150%. Now, another gripe that I have with them is as of 2 years ago to 1 year ago, it went from $23 billion to 51.86. That's a massive jump. I don't necessarily like that. I understand why that occurred, but I don't necessarily like that, so I'm giving this a 40%. When it comes into the free cash flow, we see something very similar. 5 years ago of 16.44 billion to 1 year ago of 59.6 billion. Increase of 262% with an average of almost $23 billion. Now, they did go negative once again 3 years ago. Again, perfectly understandable. However, massive drop from 5 to 4 years ago, 16.44 billion to $5.4 billion. And then a massive jump, even if you exclude this 3 year ago value, massive jump from 5.35 billion to $36.1 billion 2 years ago. I'm giving this guys a 40%. Looking now at the revenue, now when it comes to this, we're not going to see a negative value when it comes into the 3 year ago marker, but it's still a pretty big drop. 5 years ago of 281.1 billion to 1 year ago of almost $390 billion. That is an increase of 38.54%. Once again, we do see a small decrease, I would say, from 5 to 4 years ago. But as you guys can clearly see, the margin, it is not as bad as it was for the free cash flow and the net income. So for this reason, I'm giving this a 60%. Looking at the total assets minus total liabilities, within the past 5 years, they have remained roughly the same, though the trend is actually to go down, believe it or not. 5 years ago, it was $198.53 billion, and as of today, it is $193 billion. Average total assets, it is $355 billion. Average liabilities is almost $170 billion. And doing this difference, we get almost $185 billion. I'm giving this guys a 75%. Looking at the cash flow minus the liabilities, this one has some promise to it. As of the past, 1, 2, and 3 years ago, we can see that they have been getting closer and closer to zero, which is something that I like to see, probably because their cash flow just completely skyrocketed. The lowest point was 3 years ago, probably because of COVID, but again, that's easily explainable. However, from 5 to 4 years ago, we do see that decrease once again. Average cash flow minus the average total liabilities, it is negative $141.1 billion. I'm giving this a 55%. Looking at the shares outstanding, this one is actually looking not too bad. 5 years ago, 4.24 billion shares to today of 4.118 billion shares. That is a decrease on the 5 year of 2.8%. Now we do see a slight increase when it comes to these shares outstanding from 3 to 2 years ago. Probably COVID related, if I had to guess, but then they brought it back the following year. So that, in my opinion, isn't really too bad. Overall, from the previous year to the current year, there's another buyback of 2.85%. I'm giving this an 85%. And lastly, when it comes to the cash equivalents, as of last year, or as of 2022, this is a whopping $30.41 billion with an average of $8.5 billion. When it comes into the overall grades, we get the net income 40%, free cash flow 40%, revenue 60%, assets minus liabilities 75%, cash flow minus liabilities 55%, and the shares outstanding of 85% for an overall grade, guys, of 56%. My personal opinion, I mean, I've held this even beforehand. I think Chevron has better fundamentals overall. That's why I chose Chevron to begin with. I'm not saying that Exxon is bad, but I mean, it's just, at least for me, there's just too many, I guess you could say, outliers. I wouldn't even say outliers. There's just many just like uncertainties when it comes to these past 5 years. But now let's make some assumptions, low, median, high, using a revenue growth of 10, 12, and 14% appropriately. And I'm getting these numbers, guys, from Seeking Alpha's forward tab. We can see that they're expected at 25.57%. I personally don't think so. I think the oil market will eventually come down. Maybe it'll happen in the next 5 years. So I have to take that into account, and I'm going to go with 10, 12, and 14%, as I said. Now, in regards to the predicted share buyback, I did show you guys that they're planning to buy back $35 billion worth of shares back. This comes out to be roughly around 7%. And I'm going to show you guys the math behind this. So right over here, we got that they're planning to buy back $35 billion. So if we do 35 billion, right, 35 with 9 zeros, and then let's say that they buy it at this $116 price tag. So that we divide this by $116, we get almost 302 million shares. So if we do 302 million shares, divide that by the current shares outstanding, which if you guys remember, it is 4 billion, 1 million, which is 4,118 million shares, we get around 7%. So that's essentially why I'm saying 6, 7, and 8% for the projected share buyback. So with this, we get the target share prices of $58.81 to $68.44. And then adjusting for debt, this does go up by around $4 to $62.78 to $72.50. With a margin of safety of 5, 10, 50%. This puts me between $53.37 to $68.87. So as it currently stands, this is looking overpriced. However, if you guys do remember the 52-week range, it got as low as $74 or so. At that point, you could have made the reasoning to buy it at like the $67 mark, but as it currently stands, $116, it is looking really, really expensive. Now, as I said, that they do pay out a dividend, so let's see how much money you would actually get if you were to put in one paycheck, $5,725 into this company at the current annual dividends per share. This nets you almost $180 in annual dividends. For $5,725, in my personal opinion, you could do a lot better, but nonetheless, the oil sector is booming right now. Will this continue? I don't necessarily know. I don't think so. So that's just how much you would get if you were to put in this amount of money at the current price. All in all, when it comes to Exxon Mobil, as I said, I do love my oil companies, but I personally think Chevron is a lot better. And not saying that Exxon Mobil's fundamentals are bad, they're just, I guess, subpar in comparison to that of Chevron. But then again, I may have my biases when it comes to this. Alright everybody, so for the third and final company, we're going to take a look at Caterpillar. They also had earnings today, so I said this is a company that I rarely look at, and honestly it's kind of sad because this is like one of the major industrial companies out there. So let's take a look at their fundamentals, check out if at the current share price, this is looking like a buy. When it comes to Seeking Alpha's earnings summary, we got the EPS normalized actual came in at $3.86, missed by 17 cents. EPS gap actual came in at $2.79, missed by $1.02. Revenue came in at $16.6 billion, which was a beat by $682.96 million. Jumping into their earnings, we got Caterpillar reports fourth quarter earnings and full year 2022 results. Fourth quarter 2022 sales and revenues up a whopping 20%. Full year sales and revenues up 17%. Fourth quarter 2022 profit per share $2.79. Adjusted profit per share $3.86. Fourth quarter 2022 included an unfavorable MENT foreign currency impact of 41 cents per share in other income expenses, which negatively impacted profits per share and adjusted profits per share. Full year profit per share of $12.64, adjusted being $13.84. Strong operating cash flows of $7.8 billion, ended the year with $7 billion of enterprise cash, returned $6.7 billion to shareholders through share repurchases and dividends in 2022. All of that sounding really, really great, except for the fact that, well, they did get hit a little bit with the MENT foreign currency thing, but I guess it is what it is. We got over here, guys, comparing this to 2021 in the fourth quarter. In 2021, sales and revenues $13.8 billion. In 2022, $16.6 billion. Looking at the year, we got $51 billion 2021, $59.4 billion in 2022. Profits per share $3.91 in 2021 to $2.79 in 2022. And then for the full year, it was $11.83 for 2021, and for 2022, $12.64. And the adjusted profits per share, 2021 for the fourth quarter, it was $2.69, and 2022, $3.86. Looking at the full year, we got 2021, $10.81 to $13.84. So, you know, they did have a little bit of a drop here for the fourth quarter profit per share, but overall, it was still going up significantly. And now taking a look at what the CEO had to say, it wasn't really that much, honestly, but he goes on to say, our global team delivered one of the best years in our nearly 100-year history, including record full-year adjusted profits per share, said Caterpillar Chairman and CEO Jim Umpleby. That's the first time I ever heard that name. Despite supply chain challenges, the team achieved double-digit top-line growth and generated strong ME&T free cash flow. We remain committed to serving our customers, executing our strategy, and investing for long-term profitable growth. So now let's jump into the calculator and let's take a much wider look at these fundamentals. We got the ticker symbol for CAT, market cap of $131.3 billion, a PE of 18.34, with a current share price of $252.29. And so far on the 1 year, guys, they're up 25.17%. On the year to date, they're up 5.61%, with a 52-week range of $160.60 to $266.04. And just today, during the intraday trading, they went down 3.5%. And post-market, they went down another 0.3%. They do pay out a dividend of $4.80, which is a yield of 1.84%, a payout ratio of 36.38%, 5-year CAGR of 8.66 with 29 consecutive years of dividend payment. They are a dividend aristocrat. Ex-dividend date actually passed as of January 19th. Payout date was on the, well, it's going to be on the 17th of February, and they pay their dividends quarterly. Based off of the current shares outstanding, they currently pay out almost $2.5 billion in dividends every single year. And in regards to the 5-year average free cash flow, after this 2.5 is paid out, they're still left with $1.62 billion. And as of their last year's free cash flow, it is $1.3 billion. These payout ratios come out to be 66.38% for last year's free cash flow and 60.67% for the 5-year average. Looking into the fundamentals, starting with net income 5 years ago of $6.15 billion to 1 year ago of $7.4 billion, increase of 20%. Now, the thing here is that we do see a massive outlier 3 years ago, but honestly, I'm just going to attribute that to COVID. Now, we do see something else here in that 5 years ago to 4 years ago, they went down slightly. It was less than $100 million, but they did go down slightly. However, they did recover pretty nicely 2 years ago. So for that reason, guys, I'm going to give this a 65%. Looking at the free cash flow, we don't see the outlier 3 years ago. However, it does dip down a little bit. 5 years ago of $3.64 billion to 1 year ago of $3.76 billion. That is an increase only of 3% with an average of $4.12 billion. Again, the outlier here is technically 1 year ago where they went from $4.73 billion to $3.76 billion. Not really good to see the fact that this is, right at our doorstep. It was just 1 year ago, 2022, and their peak was 2 years ago. So for that reason, I'm going to give this a 40%. Looking now at the revenue, we do see now that little trough that we saw in the net income because of COVID, probably related issues. But nonetheless, you can see that in this one, they barely recovered. 5 years ago of $54.7 billion to 1 year ago of $56.3 billion. As an increase of not even 3.5%. And if we take a look at this, guys, they went down from 5 to 4, right? From 5 to 4 years ago, they went down. And then they continued to go down from 4 to 2 years ago. Sure, they did recover up from the lowest point 3 years ago, $41.75 billion to almost $51 billion. But you can clearly see that they did not even recover to what it was 4 and 5 years ago. And only 1 year ago is when they barely reached that 5-year mark and beat it by around $2 billion. So that's why I'm giving this a 60%. Looking at the total assets minus total liabilities, this was actually not looking too bad. They have been of the uptrend ever since 5 years ago. Their highest point was 2 years ago at $16.5 billion. And sure, they have come down, from 2 to 1 year ago, but they're still significantly higher than what they were even 3 years ago. Average total assets, it is $80.3 billion. Average liabilities is $64.7 billion. Doing this difference, we get $15.6 billion. I'm giving this a 75%. Looking at the cash flow minus the total liabilities, honestly, this one is weird because it has remained flat at around the negative $60 billion mark throughout the whole entire time. Ironically enough, their liabilities went down, or not necessarily their liabilities, but this difference went down to their lowest point 3 years ago during COVID. So that's something to note. I guess we're pretty COVID resistant, so it is what it is. Yeah, 3 years ago, it was negative $58.7 billion, and I believe their lowest point overall would be, as of 1 year ago, negative $61.52 billion. But you can see that there really isn't much change when it comes to this graph. Average cash flow minus the average total liabilities, we get negative $60 billion. So I'm giving this, guys, a 55%. Now, looking at the shares outstanding, this one caught me by surprise because this is an absolute beauty of shares outstanding, consistently decreasing year over year, almost perfectly on the trend line. 5 years ago of 575.5 million shares to today of 520.4 million shares. That is a decrease of almost 9.6%, and from the previous year to the current year is another decrease of almost 3%. So the fact that they've never issued shares within the past 5 years, and it's very, very consistent, and not to mention that 5-year decrease, it is way massive, guys. Like 9.6% is huge. I'm giving this a 100%. When it comes to the cash and equivalents, they currently hold $5.4 billion with an average of $7.4 billion. When it comes to the overall grades, guys, we give them the income 65%, free cash flow 40%, revenue 60%, assets minus liabilities 75%, cash flow minus liabilities 55%, and the shares outstanding of 100%. Honestly, overall grade of 63, I could see the case for around like high 60s, maybe even low 70s, right? It really is up to you when it comes to this one as to how you see these things. Personally, if the free cash flow, if I were to put this at 50%, I think this would be close to high 60s. But for me, it's 63%. So now let's make low, medium, and high assumptions. As always, I got the revenue growth right here at 8, 10, and 12%. Looking at Seeking Alpha, we can see that their estimated forward is 14.2. So me going 8, 10, and 12, I think it's fair enough in my personal opinion. And in regards to the predicted share buyback, I went 6, 7, and 8%, a little bit lower than what they have been doing in the past 5 years. I think they're going to slow this down, still continue to buy back, but just slow it down a little bit. This comes out to be, guys, not adjusting for debt, $166.72 to $194.40. And that target share price, adjusting for debt, we get $118. It actually comes down $118.33 to $145.01 with a margin of safety of 5, 10, 50%. This is $100.58 to $137.76. So as it currently stands, this is looking like it's a really, really expensive stock based off of my assumptions. But of course, to anybody saying, oh my God, it's 252, it'll never fall down to like the share prices that you said, you know, it'll never fall down to like 180 or 170. Guys, just 52 weeks ago, within the past year, they were as low as $160.60. So the fact of the matter is that if you would have talked to me about this company around like the 52-week low mark, yeah, I mean, you know, I got 166 over here. It's went as high, you know, and it's going as high as 194. So honestly, I would have probably said that this is looking like a buy, looking at the target share price, not adjusting for debt, if we would have caught this at that 52-week low. So to all those people who say, oh, it'll never fall there, well, I mean, it has already fallen there. It's just looking at this at the wrong time to buy it at right now, right? So again, every investment is the present value of all future cash flow. All of these numbers would change, and when it comes to Caterpillar, at least for me, this is looking like a pretty expensive stock right now. And of course, if we take a look at this company in regards to its dividend, putting in $5,725, this nets us an annual dividend of almost $109. All in all, when it comes to Caterpillar, I gotta say, I should really take a look at this one a lot more, because it's just one of those companies that, like, it's, I don't know why, but like I just don't think a lot of people actually look at this one like a lot. And it's sad because I honestly think that they do have a lot of prospects in the future, but as it currently stands, when it comes to stock, this is looking a little bit expensive. All in all, that pretty much does it for this video, everybody. Sorry I couldn't get to more companies, but it is what it is. I just went through the ones that I think people would like to listen to the most. I will probably take a look at more of these for the day of Tuesday. For Tuesday's earnings on Wednesday, seeing that there really isn't that much on Wednesday that I would like to take a look at. Mainly just Waste Management and Meta. It's really about it. So probably tomorrow I will take a look at Waste Management and Meta, as well as maybe one more from Tuesday. Probably McDonald's if I had to make a guess. But anyways, guys, that pretty much is it for this video. Like if you like, comment, subscribe. It really does help us here with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link in the description below. So with that said, peace out. And I will see you all in the next earnings report releases.